All right, so the first question is, a project needs an initial investment of $225,000 and is expected to generate the following cash flow. So here you can see that you have an initial investment of 225,000, and then this is the cash flow that is going to be generated from the project that you have invested in. So the earnings, that is the revenue that is generated from the project, is given here. So you can see that we start making profit out of this project right from the first year to the fourth year. And cost is basically the negative cash flow, right? Whatever, say this cost maybe it's contributed towards operating and maintaining the project. So the first 2 years there are no costs associated with it, or no negative cash flow, but on the third and the fourth year there are some negative cash flows. So this is the information provided. Now you have to calculate the net present value, and the discounted rate is given to you, 12%. So now, and finally, after finding the net present value, you have to comment whether the project is profitable or not. So I'm going to give you guys some time to try and solve this. So this should be very easy. But if you guys are not quite sure how to solve this, please let me know in the chat and I can show you the solution. Okay. So do you guys want some time to try and solve this? Yes or no? All right, great. So whenever you're trying to solve questions like this, always try to put negative and positive signs. So what I mean to say is, whenever there are some investments, so in this case you have to pay something out of your pocket, right? So this will be negative, and earnings will be positive, and this cost is also something that you're paying out of your pocket, so this will be negative. So first thing first, you have to convert this entire cash flow to your present value. So you have to discount this cash flow to present value, which is also known as discounted cash flow. So for that you have to use the formula cash flow divided by 1 plus r over here to the power n, so whatever time it is. So do this, or first you have to actually find the net cash flow, just this minus this minus this minus this. So once you get the net cash flow, discount it back to the present value, and then you compare it with this initial investment, or you subtract it with this initial investment to see whether your net present value is positive or negative. And depending upon your positive or negative net present value, you can comment on whether your project is going to be profitable or not, right? So this is the gist of it. And once you understand how to do that, all the other exercises are pretty simple, just some more additional details, but the way of solving it is pretty much the same. Okay, so try and solve this. I'll give you 5 minutes. It is 2:10, so I'll wait till 2:15. Feel free to use calculator or Excel for solving this. All right, Jin, you found the discounted cash flow as 234,000 approximately. Um, well, the discounted cash flow that I got is 217,614, and the net present value will be negative 7,385 approximately. Um, so try and solve this again. So first, just find the net cash flow, this minus this for all of this, and once you get the net cash flow, discount it back to the present value. So in this case it will be 95,000 divided by 1 plus r. R is your 12%, right, to the power 1. And for the second one, it will be 80,000 divided by 1 plus r, which is 12% to the power 2. So do that for all of this and then just add it up together, and then you will get the discounted cash flow. And I'm 100% sure your discounted cash flow is actually less than the initial investment. That's why your net present value is coming out to be negative. Try to do this one more time, okay? Check the numbers. Okay, so for the first year, it is 95,000 divided by, yes, 1 plus r to the power 1. Yeah, that's right. So do that for all the years. The cash flow amount will change and also the time end value will change, right? So what is the discounted cash flow for the third year? Okay, it is 55, yeah, divided by, yeah, that's right. So do this for all the years, then add it up together. All right, did anyone find the answer of the total discounted cash flow and the net present value? Any guesses? Hmm. Yeah, 217,614, yes, and 7385. So will it be negative or positive? Yes, it will be negative, right? Negative 7385. So for those who couldn't find the answer to this, let me quickly show you the solution. Unfortunately, I can't share Excel, so just have to share my screen. All right, so this solution file will be uploaded later on in Moodle. So let us quickly have a look at question number 1. So to us, the discount rate is given to us. So for all the years, we have the cash flow. So these are our earnings and these are our spendings. So first thing first, we have to find the net cash flow, right? So net cash flow is just your earnings minus the cost. So this way you will get the net cash flow, just this minus this for all of this. Now, once you get the net cash flow, so what we want to do is we want to discount this entire cash flow to present value. That means, so these are future value, right? So this is the value we are getting after 1 year, after 2 years, after 3 years, after 4 years. So what we want to do is we want to bring all of this cash flow into today's value. So we want to evaluate this cash flow in today's value, in today's time. So how do we do this? So for all of this, we just take this cash flow amount, divided by 1 plus r, so it is 12% to the power the time, right? So here you can see the cash flow, which is this, divided by 1 plus r, so r is your d2 to the power c5, so c5 is your time over here. So we do this for all of this, and in all of this the cash flow will change, the time will change, and the discount rate will remain same. And once you do the discounted cash flow for each individual cash flows, then you add it up together to get the total discounted cash flow. So once you get the total discounted cash flow, then you're going to compare this with your initial investment. Now, just by looking at this, you can say that initially you have invested $225,000, whereas from your project, only $217,000 is generated as revenue. So just by looking at this, even before calculating the net present value, you can say that, all right, the project is not a beneficial one, right? Because you're not even getting back what you have initially invested. So this is one way of looking at the project is not beneficial. And further, you can also calculate the net present value. Net present value is just the total discounted cash flow minus the initial investment. And therefore, since the initial investment is more than the total discounted cash flow, you get a negative number. And this negative sign indicates that the project is not profitable. So if your net present value is positive, that means your project is profitable. If your net present value is negative, the project is not profitable. Okay. All right. Is there any question regarding the first workshop? Oh, sorry, the first exercise? Is it all clear? Because we need to get this fundamental right so that we can move on to the next question. So is everyone clear of how to solve the first question? Yes, no? Is there any no? All right, no response. I'll take that as all clear. So let's move on to the next question. So I think the tricky part here is to be mindful of the Okay, Emiliana, I just joined. I'll see the recording. All right, Emiliana, no problem. So anyways, the other questions that we are going to do are pretty similar to the first one. So some points that you need to be mindful of when you're doing discounted cash flows or net present value is these signs. So I always find it very helpful if you give negative signs to all the investments and all the spendings and positive sign to all the earnings. Okay, and also when you're doing the net present value, be mindful to of the sign of the positive or the negative net present value sign, because that is an indication of whether the project is worthy of investment or not. So as I saw in the chat section, you guys found the correct values but missed out on this sign, Victor. So just be mindful of this sign. So it's not the initial investment minus the discounted cash flow, but it is the other way, discounted cash flow minus the initial investment. Okay, so just be mindful of that. All right, next question, very similar with a bit more details added. So you plan to invest 500,000 in a manufacturing facility of a sustainable building material, which is expected to generate 70,000 per year in revenue from year 3 to year 7. Again, when you get questions like this, make a table. So what you have, the information. So you have an initial investment of this amount, and then make it so for 1 year, once year 2 year, so for year 1 and year 2 there are no revenue generated, and from year 3 to year 7 you have revenue generation of positive cash flow of $70,000 per year, right? And what is happening from year 8 to 10? Again, the revenue generated is a bit higher, so instead of 70,000 you'll be getting 20,000 extra, so you'll be generating 90,000 revenue per year from year 8 to 7. So make a table. So year 1, 0 revenue, year 2, 0 revenue, year 3 to year 7, $70,000, and year 8 to year 10, $90,000. So that is your cash flow, positive cash flow. Now let us look at the negative cash flow. Your operations and maintenance expenditure is $20,000 per year from 1 to 10. Now, when we are looking in terms of the negative cash flow, this spending, it is even from year 1 to year 10, we have spending or negative cash flow of 20,000. Right. So at the end of 10 years, the manufacturing equipment can be sold for 100,000. So now, so this is the salvage value. So once you are done using the equipment, you can sell it after 10 years for this value. Now, is this going to be a positive or negative? So is this earning or spending? Anyone? Earnings, right? Yes. So this is going to be, yes, in the positive side of the cash flow. Okay, good. So now consider a discount rate of 8%. So this is the discount rate that is given to us, and calculate the net present value for this 10-year project. Also determine whether the project is profitable or not. So exactly what we have done in the previous example. So we have all the data we need. So we have our cash flow. So we have our positive cash flow. We have our negative cash flow. So first thing is to find what is the net cash flow for each year. And then we are going to discount this net cash flow to the present value by using the discounted rate that is given to us. And once you do that, add it up together to get the total discounted cash flow. And then we subtract it with the initial investment to find the net present value and see whether it is positive or negative to determine whether the project is profitable or not, right? So again, I'm going to give you some time. So maybe, so this is a bit longer. So maybe I'll give you time till it's 12:23 now. So 12:30 p.m. So you have 7 minutes, and yeah. So try and solve this later on. If you can't, I'll show you the solution as well. Okay. Meanwhile, if you have any question, just pop it in the chat, and I'll get back to you. Okay, Emiliano. So the formula is, so first what you have to do is find the net cash flow for each year. And once, yes, so once you get the net cash flow, so for discounting every year, so for discounting the future value to present value, the discounted cash flow formula is your cash flow divided by 1 plus R. R is your rate to the power. Yes, and so future value divided by 1 plus I to the power n. Yes, exactly. So this is it. So do this for each year and then just add it up together. Yeah, yes. Okay, sorry. The maintenance is 20K. Is it in present value already? No, no, no. So the maintenance and everything is given in future value. Okay, so we have to discount that as well. Okay, calculate cash flow, discounted cash flow, and yes, net present value. Yeah, that's right, Jin. Okay, so a net present value is negative 212930. Let me quickly check. Yes, 212930. That's right. Good job. Um, yeah, and what was the discounted cash flow? Not profitable. That's right. All right. I think most of you got the solution, but I'm going to quickly go over the solution file anyway for anyone who didn't quite get hold of this. Okay. So, but yeah, this is the correct value of net present value. And from here, as we can see, that net present value is negative. Therefore, the project is not profitable. Discounted cash flow includes salvage. Yes, of course, you will have to. So the salvage value is given after 10 years. You will have to discount that to the present value as well. I hope that's how you got the net present value, right? 212930. We already removed the initial investment from discounted cash flow then. Not sure what you're asking, Emiliano, but let me quickly show you the solution so that you can see how it is solved. Just hang on. I have to share my screen. Is there anything in the chat? Okay, you can check it for yourself. I'm going to share the solution now. Okay. All right. So question number 2. This is what information is given to us. Um, so we have our discount rate is 8%, and this is our cash flow, right? So from year 1 to year 10, this is our incoming. So year 1 and year 2 we don't have any profits. From year 3 to year 7 we have incoming cash flow of 70,000, and from year 8 to year 10 we have incoming cash flow of 90,000. Now our outgoing cash flow is this 20,000 each year, and then our salvage value on the 10th year, which we are going to get, is 100,000. So now we have to find the net cash flow, so which is this incoming minus the outgoing. And for the first year and the second year, it is going to be negative because we have negative cash flow and no positive cash flow, right? And here, so the cumulative will be positive. And for the last year, here we are going to add up the positive cash flow, which is our revenue generated plus the salvage value, and minus the outgoing cash flow, which is 20,000. So this plus this minus this will give you 170,000. So this is the cash flow for the 10th year, right? So this is our net cash flow for all the years from year 1 to year 10. And then we are going to find the discounted cash flow, or we are going to evaluate this money in today's time. So again, we use the same formula. So this cash flow divided by 1 plus R is our rate, 8% to the power the time. So we do this for all of this, and we get the discounted cash flow for each of this individual cash flows. And then we just add it up together. So here you can see we have just added up from age 6 to age 15. So we just add all of this up together to get the total discounted cash flow. Now, our initial investment was given to us as 500,000, and the cash flow generated here, you can see, is less than what has initially been invested. So again, just by looking at this, you can say that, the project is not profitable because the income generated is less than what has been initially invested. And if you want to find the net present value, just total cash flow, total discounted cash flow minus the initial investment, which is a negative number, and this is your net present value. And just by looking at this net present value, you can say that the project is not profitable. Here you can see the investment is not profitable because you're incurring a deficit, or you're incurring a loss in the net present value by approximately $212,000. Okay, so this is the solution for the second exercise. Any question regarding this? Is it all clear? All right, okay. So let's move on to the next question. We have quite a lot to cover today, so let's not dwell on each question for a very long time. All right, so question number 3. Let me grab the pointer. So yeah, it's again similar to the previous question up till here. The only new thing that we are going to be introducing in the next question is the internal rate of return. Now, can anyone tell me um, what is the relationship between IRR and net present value? Is there any relationship between net present value and internal rate of return? Anyone? Okay, so yes. So what is the question was, what is the relationship between IRR and net present value? So internal rate of return is that rate at which your net present value becomes 0, right? And we are going to use this concept to find the IRR here. Yeah, so Victor, yes, you're right. Doris, IRR is the rate when net present value is equal to 0. Yes, that's right. So another question relating to IRR. So for a company, if they are, so for an investment, so say there are 2 investments and 2 different IRRs. So one has an IRR of 10% and other has an IRR of 20%. So which one is better, project A or project B? So a question is higher IRR better for a project or lower IRR? What do we prefer? Higher, right? Yeah. So internal rate of return is basically, so when a company is investing in a project, so what is the rate of return that they are getting on their investment? So higher the internal rate of return, the better it is for the project, right? So 2 important concepts relating to IRR. Firstly, IRR is that interest rate where net present value is equal to 0, and always a higher IRR is better for the project. Okay, so now let's have a look at the question. A leading developer in Australia invests 2 billion for a commercial car park. So this is our initial investment. The car park is expected to receive $250 million per year for private parking over 30 years. So we have our positive revenue generated over a period of 30 years, which is $250 million per year. Annual maintenance cost is 1 million again. So this is our negative cash flow. This is our positive cash flow from the project. So you can find the net cash flow, right? this minus this. After 30 years, the government will purchase the car park at 1.5 billion. So this is our salvage value. So this is again a positive cash flow that will be added to this at the end of 30 years. So now you have to calculate and plot the net present value versus different discount rates and find the IRR. So here you will see that the initial investment is given, the positive cash flow or the positive revenue generated over 30 years is given, the spending over 30 years is given. But in order to discount this, you don't have a discounted rate that is given to us. So here what you're going to do is you're going to assume a range of discounted cash flow, and usually I like to assume somewhere between 10 to 25, and then for all of this discounted all of this discount rate, you're going to find the net present value, right? And once you find the net present value, you're going to find that those two discount rates where the net present value is going from a positive number to a negative number. And then you can say that, okay, our IRR lies somewhere between these two discount rates. And then you can extrapolate and use Excel to find the exact IRR. Okay. So can you guys go ahead and try and solve this, or do you guys want me to show the solution to you? Um, do you know how to approach this kind of questions? Okay, you can try. So try to take discount rate maybe from 10% to 20%, maybe try between that range. So you can try 10%, 15%, 20%, and see if the net present value is transforming from a negative to positive, positive to negative number. Okay. All right, so the time is 12:39. Maybe take a bit longer here, 6 to 7 minutes. If you need more time, I can give you more time as well. Okay, Victor, yes, it is approximately 12.3%. Yes, right. Anyone else who got the number for IRR? Okay, so let me quickly show you guys this solution. Victor, let me know if your approach is a bit different because the answer is same. This this approach. So did you plot the discount rate versus net present value, and then find the equation for that line? Did you use that approach? Okay, I'm going to show you what I have done, and let me know if your approach is a bit different or if you have an easier approach. Okay. Let me share my screen. All right. So this is what we have. So for from year 1 to year 30, we have the we have the income generated over here, 250 million, right? And then, so this is all positive cash flow. And then we have our negative cash flow, which is 1 million each year for maintaining the car park. And then also at the end of 30 years, we have salvage value of 1.5 billion. So we first find the net cash flow. So just this minus this, or just this plus this if you're already putting a negative sign. And then you find the net cash flow. And at the end of 30 year, apart from this, you're also adding up the salvage value. So therefore, the cash flow at the end of 30 year is 1.7 billion approximately. All right, so first you have to find the discounted cash flow, and since the discount rate is not given to us, we are assuming a range of discount rates over here. So I have assumed 10%, 15, 20, 25, and 30. You can also consider a smaller range just to check, and then later on you can decide if you want to expand the range of discount rates. So anyway, so considering 10%, you have calculated discounted cash flow, and considering 15%, you have calculated discounted cash flow, and so on for 20, 25, and 30. So we have our discounted cash flow for each of these interest rates. So now we add up the all the discounted cash flow to find the total discounted cash flow, and we know the initial investment, which is 2 billion. So we are just going to subtract the discounted cash flow with the initial investment to find the net present value. And here you can see the net present value is transforming from a positive value to a negative value between 10% and 15%. So it is safe to assume that your IRR is going to be somewhere between these two numbers, right? Because your IRR is that interest rate where your net present value is equal to zero. So somewhere between this positive and negative, there is going to be zero, right? So your IRR is somewhere between 10 and 15%. So what I have done here is I have taken this as the x-axis and this as the y-axis, and I have plotted a graph. So for this, you can just do, sorry. I hope you guys know how to do this. Just um, select this, and just go to insert, and then in the recommended chart, you can get this. All right, so going to delete this, but that is how you can get this plotting over here. And then to find the exact value, Victor, just tell me if you have done it a different way. What I have done is for this line, for this plot that we have got, I have just found the equation. And how to find this equation? Just right click, format thread line, and then you can select the best fit. You can see the line is not a best fit. Logarithmic is a bit better than line, but not a bit better than linear, but not the best fit. And then I have went to polynomial, and you can see that it's pretty much fitting into the curve. And then we want to find the equation for this polynomial curve. So for this, you can just select onto, sorry, just select onto display equation on chart, and you can also select the order of these equations. I have selected 3 to keep it a bit simple, and then just by doing this you get the equation. And we know the y value, right? So we want to find the x value. So we want to find this value when y, or your net present value, is equal to 0. So just put 0 in this equation and use your calculator to find the value of x, and the value of x that fits in between 10% to 15%, that will be your desired x value. And I think even I got somewhere I think 12.34 or something like that. So it's approximately 12.3% for your IRR. Okay, let's get back to our main slides. I just adjust IRR in order to get okay, net present value of 0. Yeah, you can try that. So you can try couple of I think mine is just maybe a bit complex, but since for your exam you are free to use Excel, I think, so it should be fine. But you can of course try. So since you know that your IRR is going to be somewhere between 10 to 15%, you can try out couple of different interest rates between these two numbers and then try to find out the interest rate which will give you a net present value approximately equal to 0, right? So either you can do a trial and error like that, or you can just use the method that I showed, try and find the best fit line for that curve, and then try to find the equation for that curve and just put the value of net present value or y value as 0 and try and find the x value. So that is one way of doing it, right? Okay, any question regarding this IRR? I think it is very important from your examination point of view as well, okay, for your final exam. Okay, so we have, how are we doing on time? Okay, almost 50% covered and almost 50% of the time. Okay, so let's move on to our next question. Again, this is pretty simple, just using the discounted cash flow method. So the question is, you need to make an investment decision for your company. So this question is basically, again, an example of how you can use this discounted cash flow method to compare different investment options and select the best alternative for your or select the best scenario that will give you the maximum return, right? So the question is, you need to make an investment decision for your company which invest in wide range of commercial projects. Your company wish to invest 5 million and a site is selected for this possible investment. There are four options that are under evaluation. First is to invest in a shopping center, second is to invest in a cinema hall, third is to invest in a 10-story car park, and last is just to deposit it in the bank, and the study period is given as 10 years. So we have four scenarios here. So we have some amount of money with us. Now we are looking into these four investment scenarios and we want to see what kind of return we are going to get from these four scenarios in a period of 10 years. So for each of the scenarios, some more details are given to you regarding the revenue that will be generated, the spending that will be there, and also the interest rate. All right, so first for the shopping center, the company planned to make an investment. Of course, we have the same investment amount, which is 5 million. And the cash flow looks something like this. So from Tennessee, which is the money you're getting on from rent. So when you rent it out, then you will get 1 million from year 3 to year 7. So first year and second year, there won't be any profit. From year 3 onwards to year 7, you will make profit of 1 million from the rent that you will collect, and from year 8 to 7 the rent will increase a little bit and you will get 1.5 million between this years. Now, so these are all the positive cash flows. Now, the operations and maintenance cost would be 70,000 from year 1 to year 10. So this is our negative cash flow, right? So from year 1 to year 10, your negative cash flow is uniform, which is $70,000. So now again, so just picture the table. So you have your positive cash flows, you have your negative cash flows. First you have to find the net cash flow, and then using this discount rate you're going to discount it back to the present value, and then you subtract it with the initial investment to find the net present value, right? So this is for scenario 1. And similarly for scenario 2, which is to invest in a cinema hall. Again, you have the same initial investment amount. The positive cash flow is 900,000 from year 2 to year 10. So in year 1, there is 0 positive cash flow, while the operation and maintenance cost is estimated to be 200,000 from year 1 to year 10. So we have negative cash flow right from year 1 till year 10, and discount rate is given to us. So I won't read out all the scenarios. So these four scenarios are there. All right, maybe the last one. And this is again similar to this, just with different numbers. And the last option is the company can directly invest it, or just keep the money in the bank. And by doing this, they will earn a simple interest of 2% annually. So just go back to the formula of simple interest. So it is principal amount into interest into the time. So you can find out what amount of money you will earn at the end of 10 years if you have a simple interest of 2%. And then the interest will not be paid until maturity after 10 years. That means this simple interest amount, you will get this only after 10 years. So again, you will have to discount the simple interest amount to present value and see if this value is more than the net present value of the others. So adjust the present value considering a market inflation rate of 5%. So now here you can see there are two interest rates. Don't be confused. We are going to use the first interest rate to calculate the profit that we are going to get out of this $5 million that we are going to keep in the bank for 10 years. So we are going to use this interest rate to calculate that profit amount. And you're going to use this 5% interest rate to discount whatever profit you have earned after 10 years to the present value. So this is where you will use this interest rate. And now you're going to compare the net present value of all these four scenarios to find out which scenario is the most profitable one. Okay. So again, I'll give you some time, maybe 6 to 7 minutes to this. Um, Try to find a net present value and try to find which is the most profitable option for this. Okay? And if you have any question, as usual, just put it in the chat and I'll get back to you. Also, if you have not downloaded the question and if you're done solving for scenario one, just let me know and I can change the slide back to the other scenarios. Okay. Okay, it's getting too quiet. Did anyone find the net? Sorry. Did anyone find the net present value for the shopping center? 208K. Let me check my solution. Yep, you're right. So the net present value is 208K for the first option. What about the second one? Yes, kind. It's 208. Okay, let me get to the next one. Okay, did anyone find the NPV for the cinema hall? Okay, maybe I should give you guys some time to work on. Right, so it's negative 697. Yes, it's negative 696. That's all right, yeah. So yeah, it's a negative net present value, so definitely not profitable. And um, sorry, what number is 996? 10? I'm not sure what 996 is. Did anyone find the NPV for the car park project, the third scenario? Hey, it's 415. Yes, you're right. It is 415. What about the last scenario? So first, can you tell me what will be the interest earned after 10 years? Do you guys know the formula of simple interest? So it's the principal amount into the time duration into the simple interest rate. So 5 million into 10 years into 2%. So that will give you the profit earned after 10 years. Okay, and then you have to discount that back into the present time to see how much is the profit earned from that in today's value. Mm, 609. I think the answer should be 613K. So how did you find this, Victor? How did you? So what is the simple? So what is the profit earned at the end of 10 years? What is that amount? Or the interest earned after 10 years? What is that amount? It should be 1 million, right? And you have to discount that 1 million amount It's the formula. It is the formula. Yes. This times 1.02 into 10. Yes, that's the formula. And then your answer by doing this should be equal to 1 million. And then you have to discount that 1 million amount into the present time by using the discount rate of 5%. And your time n value will be 10 because you're discounting the amount to today's the amount that you will be getting after 10 years in today's value, right? So n value is 10, your R value is 5%, and your cash flow after 10 years is 1 million. So if you do the discounting, then you will get 613K. Let me check the formula. K26. Okay. Anyways, so by looking at these four options, so for option one, your net present value is 208K. Your for option two, it is negative 696. For option three, it is 415, and for option four, you have 613. So what is the best option to go for this? You know what? It might be a bit confusing, so I'm going to show you the solution so that you can give me a clear answer to this, okay? So let me quickly head on to share my screen again. Right, so these are the four scenarios that we have: shopping mall, cinema hall, car park project, and bank deposit. So for each of these scenarios, we are going to calculate the net present value, or the profit that is earned from each of this option, or the loss that we are going to incur from each of these options, right? So for shopping mall, we have the cash flow for all the 10 years. I'm not going to go into a lot of details. Just look at the positive and negative cash flow by looking into the question. We find the net cash flow, the discount rate is given to us, so we discount all of this to present value and we get the total cash flow, and we have our initial investment of 5,000. So just by looking at these two numbers, we can see that we have a benefit of about 208K, or our net present value is 208K, or we can say that in today's time, if we compare the initial investment to that of the profit that we are going to make, or the cash flow that we are going to generate from this project, then we can see that in today's time we are going to have a profit of 208. So this seems like a good option, but before we jump onto our final decision, we have to look into the other options as well. Now, looking at the second option, which is to invest in a cinema hall, again, we have the cash flow given to us, the positive and negative cash flow in the question. We find the net cash flow, and again, we discount all of this by using the discount rate that has been provided in the question, add it up together to get the total discounted cash flow. And again, just by looking at this two number, your initial investment is higher than the net revenue that will be generated from this project. So we can say that this project is a loss-making project, or you can say that the negative cash flow is this minus this is a negative. So the net cash flow is a negative value. So we are going to incur a loss of 697K if we invest in this project. So definitely not a good option. So we have this one so far, and we are going to compare with the other two. Sorry. Similarly, for the car park project, we have the cash flow for the next 10 years, and we find the net cash flow, we discount it to the present value, and again, we just by looking at the total discounted cash flow with the initial investment, we can see that there is some benefit, which is approximately 415K in today's time if we decide to invest on this project. So far, by looking at these three options, this one had positive net present value, this one has positive net present value, so and this one has a higher net present value, so this is a better option out of all the three. But we are also presented with another scenario where we can just deposit the money in the bank. So we have an initial investment of 5 million. You can put all the zeros if you want. This is just to make it more easier. And then it is given in the question that you will earn a simple interest of 2% after which you're going to get after 10 years if you decide to invest this $5 million amount in the bank. So first you want to see what is the earnings that you will get out of this deposit. So the earnings that we have calculated here is just to multiply the principal amount that is over here into the time period, which is 10 years, into the a simple interest rate, which is given here. So now if in your exam you're given compound interest rate, that will have different formula, but here you are told that you will earn your interest based on simple interest rates. So just do this and you will get the total earnings because of this deposit at the end of 10 years. Now, clearly you have your initial investment, and on top of that you are getting this benefit. So clearly you can say that this is a beneficial project, right? And you want to compare whether this benefit amount is higher than this benefit over here, or this profit over here. So what you want to do is you want to discount this earnings at, which are going to get at the end of 10 years to today's value, and you want to compare this two and see which one has a higher return. So next, you're going to discount this value to today's value by taking a discount rate of 5%, which is given to us in the question. So again, we do this divided by 1 plus r. So here we have done K26, which is this, divided by 1 plus r to the power 10, which is our time period. And we can see that the profit that you're going to get out of this amount which you're going to deposit in the bank is 613K in today's value. And out of all the four options, you can see that this return is highest of all of them. So in this case, depending on the money in the bank, depositing the money in the bank is the best option, considering that it has the highest net present value compared to the other investment, or in other words, this has the highest return in today's valuation compared to the other scenarios. Okay, so very simple logic here. Is there any question regarding this exercise? Is it all clear? So for the next few questions, I'm not going to dwell much longer because I think it's kind of repetitive. So these questions are given. Can you explain 1000 again? Okay, sure. So in deposit, okay, hang on. Let me go back to sharing my screen. All right, Jin. So the scenario is you have 5 million. So this is just, we have taken out few zeros here. So this is, you have an initial deposit of 5 million that you can deposit in a bank. And if you deposit this 5 million value in the bank, then you're going to get some return after 10 years. And that is 2% simple interest return. So you want to find what is the amount of return that you're going to get from this investment at the end of 10 years. So how do you calculate this? So the earnings at the end of 10 years, you calculate this by multiplying the principal amount. So principal amount is basically your initial investment, which is 5 million. Principal amount into the time period for which you have deposited in the bank, so which is 10 years, into the simple interest rate that a bank is giving to you. So the bank is giving us the money with an interest rate, simple interest rate of 2%. So this is 2 divided by 100, just converting percentage into decimal points. So principal into time period into the simple interest rate. So this will give you the actual monetary value that you're going to get out of this deposit at the end of 10 years. So at the end of 10 years, of course, so imagine, so if you put some money in your bank, which is 5 million, so of course you're going to get this 5 million, and on top of that you're going to earn some interest, right? And that some interest is 1 million, which we have calculated here using this formula. So in total in your bank you're going to get this as well as this. So what you want to compare here is, apart from this initial investment, this, you're making a benefit, you're making a profit of 1 million at the end of 10 years. So you want to transform this 1 million profit that you're going to make at the end of 10 years to today's value by using this inflation rate 5%, and you're going to compare this with the profits of the other investment, and since we can see here that the profit that you're going to make out of this investment is higher than the profit we are getting from the other investments, so it is better to go with this options of depositing your money in the bank. Okay, I hope that was clear. The, sorry, what do you mean by this? No, it's not to the power time, it's into time. So the what is F? Oh, I think you want, but why do you want to calculate the future value? We want to discount the interest that you're earning at the end of 10 years to present value, right? So just the other way around. So the present value is, yeah, future value. So yeah, you have just put the left hand side into the right hand side. That's fine. So the formula is the present value is equal to future value divided by 1 plus r to the power time. Yes. Right. Okay, let's move on to our next question. So question number 4 is done. Now question number 5. No, so interest each year, right? Sorry, Jin, I'm not sure what you're trying to ask, but let's have a look at the question again. It says that, okay, Victor, thanks for helping out, but I'm not sure what 1,000 interest each year, right? So 1 million or 1,000 in a number, yeah. So 1 million that we calculated is the interest or the amount that you're going to get at the end of 10 years. Okay. Whatever makes you understand this, but it's very simple. I'm not sure why you guys are complicating this. So if you look at the question, it says that in this case the company will not make the investment, just keep the money as a bond in the bank account. So here is the important bit. Earning a simple interest of 2% annually for 10 years. Yes, interest will not be paid until maturity after 10 years. So the profit that we are, even though the simple interest rate that we are getting is 2% annually, but the total interest that we are getting will be paid to us at the end of 10 years. Therefore, this $1 million that you are receiving as profit from this investment, yes, you will be getting this at the end of 10 years. Even though you're earning some interest every year, the accumulated amount will be paid to you at the end of 10 years. So this 1 million that you're getting as a profit, you will receive this at the end of 10 years. Therefore, you have to discount it back to the present time by considering a time period of 10 years. Okay. So even though you're making some profit annually, this won't be paid out to you. Yes, you will be getting, so as I told you, you will be getting some profit every year, but you won't be paid out this total amount before the end of 10 years. Because here we are not only concerned about finding the return of our investment, but we are also concerned about at what point of time you will be receiving this money. If you would have received this money earlier in the time period, then that value will be something completely different. But here it clearly says that the interest will not be paid until maturity. That means even though you're earning some interest annually, the accumulated amount will be paid to you only after 10 years. I hope that is clear. And for finding the interest, finding the interest earned after 10 years by using the simple interest, it's just the simple interest formula, which is principal into time into your simple interest rate. Okay. Well, try to see the solution one more time. If you are still not clear about this, we can talk about this in our next workshop. So I have quite a lot to cover. Sorry, I'm rushing a bit, but we have two more exercises and a couple of MCQs. So I have to hurry in this part, okay? But feel free to go back to the solution. And if you have any question, we can talk in the next workshop. I also have to show you guys some of the replies that I got from Sauradeep regarding our last workshop, if we have time for that, or we can discuss it together in our next workshop. Okay, question number 5. Calculate life cycle cost of two cars over 2 years with discount rate of 2%. What would be the net savings against each other and saving to investment ratio? So two car models are given to us, 2012 Holden and 2017 Toyota. And various expenditures relating to both of these cars are given to us. The current price for both these cars, the fuel consumption, the maintenance cost, the insurance cost, and the salvage value after 2 years, the emission, yeah, the amount of emission and the carbon tax. So all of this is given to us. So what we have to find is the life cycle cost. That is basically the total cost, including all of this over here, along with the environmental cost associated with it. So you have to find the life cycle cost for both of these cars, and then we have to compare them by finding the net savings against each other and saving to investment ratio. So, do you guys want to solve this yourself, or can I just go ahead and show you the solution? What do you guys want? Do you want to try and solve this yourself? Okay. Emiliano says he would like to see the solution. All right. So because this is very similar to what we have already done, last term solution created a lot of confusion. Okay. All right, so I'll go ahead and show you the solution. So this is basically very similar to what we have already done. I believe there are contradictions with the lecture slides. Okay, not sure about that, but I'll show you the solution and we can discuss. Even I have some doubts here, but uh, yes, even I have some doubt regarding saving to investment ratio, and I plan to talk to Ali and Sauradi because these doubts were raised yesterday. So I'll talk to Ali and Sauradi and get back to you regarding that. All right, so let me go ahead and show you the solution for this. Just hang on. All right, sorry. Question number 5. So we have two car models, right? So 2012 Holden and 2017 Toyota. So you know what? I'm going to split my screen so that you can see um, both the question and the solution for this. Okay, so let's have a look at the question. So I hope my screen is visible to you guys. So we have two car models, the 2012 Holden and 2017 Toyota. So first is the current price is given. So the price is already given in today's time. So you can directly put for year zero. So it's if you want to go for the 2012 Holden, then you will have to pay. So this is something that you will have to pay. So it is negative 18,000, right? And sorry, let me quickly get back to the chat. I heard something. So the solution of workshop, it is given a percentage in the slide described with dimension mismatch. Sorry, what are you talking about, Emiliano? So what percentage? Um, okay, sure. Even I have some doubts, but anyways, I'll talk to Ali and Sarah. They even cleared it out. Um, okay, where's my Excel? All right, so if you want to go for 2012 Holden, so you will have to pay 18,000 in today's price, so year zero. Now you're going to find out all the expenditures that you will have to incur in year one, both for Holden and for Toyota. So let's see. So we are going to look at the fuel cost. So the fuel cost, it says that the first in order to find the fuel cost, you will have to find the fuel consumption. So the fuel consumption is 8.1 liters for 100 kilometers. Now it says in a question that you're going to use an average of 10,000 kilometers per year. So we just have to multiply yeah, so we just have to multiply this two to find the total fuel consumed in the first year. And once you find the total fuel consumed, you can multiply it with the fuel price for per liter, and then you can get the total fuel price for the first year, right? And since there are no details mentioned here, so we're just going to assume that the same amount of fuel is consumed for both the years. So here you can see that the fuel consumption is 8.1 divided by 100, so which is fuel consumption per 100 kilometers, with that of the total distance covered each year over here, and then we're just going to multiply it with the average cost of fuel for per liter, and then you get the total fuel price for first year. And we are going to assume that similar distance will be covered and similar fuel price for the next year, and you will get the same amount for year 2 as well. Okay, so this is about the fuel cost. And next is maintenance cost. Now for maintenance, it says that you're going to spend $100 per 10,000 kilometers, and luckily for us, we are going to cover 10,000 kilometers per year. So you can just put this value for year 1 and this same value for year 2 as well, because we are assuming same distance will be covered for both the years. All right, and then what do we have? Insurance. So insurance is $1,000 per year for Holden, and for Toyota it is $12,000 per year. So here insurance cost, we are going to put in 1,000 for the first year, 1,000 for the second years, and for the Toyota it is 1,200 for the first year, 1,200 for the second year. All right, so what else do we have? Now, next is the salvage value at the end of 2 years. Now, this salvage value we are only going to get at the end of 10 years. So the remaining value or the salvage value, here it will be 0 because I'm not getting any salvage at the end of 1 year. We are getting 15,000 at the end of second year for the first car model, and 16,000 at the end of second year for the second car model, right? So last one is carbon tax. So now for the carbon tax, first we have to find what is the total emission, and then we are going to multiply that with this carbon tax value. So it is given that you're going to emit 2 kilograms of CO2 equivalent for per liter fuel consumption. Now remember, in this step we have already calculated the total fuel consumed, which is this into this for each year. So we get the total fuel consumed, so we just multiply it with 2 kilograms to find the total kilograms of CO2 emission for that total fuel consumed, and we are going to multiply it with $1 to find the total carbon tax value. So if you see the Excel, then things will be more clear. So you find the total carbon tax for year 1, and again for year 2 it is similar because the carbon tax value is similar, the total fuel consumed is similar, and then you find the similar, you find carbon tax also for your second car model. So now all of this will be negatives because except the salvage value, which will be positive, salvage value is the remaining value. So apart from this, which you are getting by selling the car, all the others are expenditures. So all the others are negative cash flows, right? So again, it's very simple. So the way it has been done here, I think this is a bit complicated. Just avoid this. So what you can do is simply add up what is the total spendings or earnings or the net cash flow for each of these years. Okay, you can do this if you want to, but I would rather do it this way. So for year 0, just this. So write this over here. And for year 1, the net cash flow is just add all of this up together, all are negatives. And for year 2, it will be this plus this minus this because the sign is different, and plus this. Or just add all of this up together. You already have the signs here, and you will get the total cash flow for year 2. So similarly, do this for this model as well. And now once you get the total cash flow for each year for both the car models, you can just discount it to the present value. Is there a discount rate given to us? Yes, the discount rate is given to us as 2%. So just use this discount rate to discount the cash flow to the present value. And then yeah, so you get the life cycle cost. That is how you get the life cycle cost. So life cycle cost is basically similar to just considering the or the and it's just the entire cost associated with the project or the model throughout its lifetime. So that is what life cycle cost is. So here we are assuming that this car model will have a total life of 2 years, or at least if I'm buying this car, I'm assuming that I'm just going to use it for 2 years, and I want to find all the costs associated with this model in this entire 2 years duration, including the carbon tax value, including the salvage value, and the initial investment in insurance and everything else. So just discounting this cash flow to present value will give you the life cycle cost. And as you can see here, so now when you compare these two car models, the life cycle cost of these two car models, then you can see that both are negative because you're in both for purchasing or operating both these car models, these are liabilities, right? So it's basically money going out from your pocket. But if you want to compare, which one do you think is better? 2017 Toyota, 2012 Holden. So which one has less spending? So both of these are spending, so negatives, and which one has less spending? The Toyota one, right? So yes, so I hope I don't want to go back into the chat right now because I'll have to exit the screen. But if your answer is the Toyota, so yes, that is a better option, because even though you're spending in both the cars, the spending with regards to the Toyota is a bit less than the spending when you consider it with that of the Holden. Okay, so net savings, this is where I'm a bit confused, and help me out if you guys have better understanding of this. So in the question it says that what would be the net savings against each other? So in the solution it is provided that we are subtracting this minus this. So my question is it fine to subtract this minus this or this minus this? Because if in your exam you get if in your exam you get MCQs, then this can be a bit confusing, the sign, because if you're subtracting this from this, you will get a negative sign. If you're subtracting this from this, then you will get a positive sign. So that might be a bit confusing. But if it is not MCQ, then of course you can write it down to explain this sign. So if you're subtracting this from this, as you have done here, then you can say that by deciding to spend, or if you buy a Holden instead of Toyota, then you will incur an additional loss of $2,194. Or in other way, if you're subtracting this from this and you get a positive value, then you can say that by deciding to go for the Toyota 2017 model, you are saving up this much money. If you Okay, sorry, let me reframe the sentence. If you subtract this from this and get a positive value, then you can say that by deciding to go for the Toyota, you are saving up this much money in comparison to what you would have spent if you would have gone for a 2012 Holden. So if you get this opportunity to explain yourself, then I guess you can do any of it, and you can explain your answer. But if in your question, if it is MCQ, then this can be a bit confusing. So I'll talk to Ali and Sauradev regarding this, if you can do either way, and if it is fine. And next is savings to investment ratio. So again, in the savings to investment ratio, what is done is just the net savings divided by, which is B12, divided by initial investment into 100 per 100. So that will give you in terms of percentage. So about 12%. Okay,
Sir,
yeah,
yeah,
you have
they're
your.
pretty. That there is where I am not totally convinced because
Mhm.
I remember when we were last term in sustainability construction, we did the same
Yeah, Hamid
example,
was, yeah, I
and,
think Hamid was taking
and
that
it
too.
was exactly the same. It made sense back then. But then while doing
Hmm.
the assignment, we were
Hmm.
going into the lecture notes,
Yeah.
and I quote, the
Hmm.
savings to investment ratio, SIR, is a dimensionless measure of performance
Hmm.
that expresses the ratio of savings to cost. So here,
Right.
what the lecturer is saying is that we would have two values of investment ratio, because let's say that we will have one SIR for the
Yeah.
2012 Holden and one
Yeah.
SIR for 2017 Toyota, and
Exactly.
the savings per investment would be those salvages values in
Hmm.
each project, and then we would have the saving of the Holden would be 15,000, over the initial investment, which was 18,000, and then we'll have another SIR for the Toyota, which is the saving of, I think it was 15,000 as well, or 10,000 over the initial investment, which is 18,000, and it would be a dimensionless value. It wouldn't be percentage according
Percentage.
to
Right.
the lecture slide.
Lecture. Okay. So wait, so you
That's
are
that's
saying that
it.
for the first scenario, yeah, that is where my another question is again. For the first scenario, so you are saying that so the net savings will be similar, right? So it is net savings divided by whatever initial cost you're considering. So the net savings for both this situation will be similar, right? But here conveniently the initial cost is similar for both. So it is just taken before. But if this was different, so you are saying that the denominator will be different.
Yeah, because what happens if we have two different projects with two
Yeah,
different initial investments?
yeah, exactly. Yeah. Yes. So that is what my question is again. So I plan to talk to Ali and Sauradip regarding that. And also, as I told, like for finding savings to investment ratio, so it is net savings divided by initial investment, right? So again, even the net savings, like do we subtract this from this or this from this? So it will give us different values. And also, of course, as you mentioned, the denominator for both these situations can be different if we have different initial costs. That is what your question is, right?
Yep.
Or did I confuse you? Wait. Um,
Yeah, I mean, I think there should be two values
mhm.
per concept.
Definitely. Yeah,
Yeah.
exactly. So yeah, even I think so because in here conveniently, I think here the solution that has been provided here, this is doing the savings to investment ratio for the Holden when we compare the net savings with Toyota. So definitely, I feel like if this value would have been different, and if you're finding the savings to investment ratio for the Toyota, then the denominator, so this value would be actually be C4. So this would have been different. But just to confirm this, I'll talk to Ali and Sauradeep and I'll get back to you regarding this in the next week. Okay? All right. So a bit confusing here, but again, I'll get back to this. So last term, Emiliano, when we did this for the other ones, all these calculations were looked after by Hamid. So I don't clearly remember if this came up in the workshop. But yeah, I even we came up this with the similar issues in yesterday's workshops. I was just waiting to collect all the queries together before I write an email to Ali. And regarding the queries from last workshop, so we are going to discuss that at the end of today's workshop. Okay. All right. So let's move on to the next question. So just hang on for this question till next workshop if you have any more doubts. All right. This we already did with some doubts. So the last calculation type of question that we have is okay. The following net cash flow for project, let me grab the pointer. The following net cash flows for project A and project B are shown as follows. Okay. What is the internal rate of return of each project? Which one would you prefer best based on IRR? Again, this is similar to the third question that we already did. So we have two projects, project A and project B, and the cash flow is given. So we have initial investment of some amount. Negative means the investment or the money that is going out of our pocket, and then positive is the earnings that we are starting to get or the revenues. So both the positive and negative cash flows for both the projects are given. So that means there was some initial investment made in today's time, and throughout the project duration some revenue is expected to be generated. So now again, what we have to do is we have to find the IRR for both these projects. And as I told you, a higher IRR is a better investment option. So we want to find the IRR for both these projects, and then we want to see which one is a better alternative. So as we already did a similar question like this, I'm directly going to show you guys the solution. Okay. Just give me a second. Right, where's my Excel? Okay. So question number 6. So what we have here in the question is we have our timeline and we have our cash flow for project A, we have our cash flow for project B. So now since we don't know what the discount rate is or what the IRR is, so again similar to what we have previously done, we are going to assume different discount rates and we are going to find where the net present value for each of this project is going from a positive to negative. So let us look at the first calculation where we have considered a discount rate of 10%. So now what we want to do is we want to discount all of this cash flow for project A into the present value by using the discount rate of 10%, and we have done it here. Again for project B we have done it here, and then we just subtract the cash flow with that of the initial investment to get the net present value, right? So here is the net present value for project A and net present value for project B using a discounted cash flow rate of 10%. Now similarly we do the same calculation for project A and B by considering a discount rate of 15%. Now you can see that when we are increasing the discount rate, the net present value is approaching zero, but not yet. So we keep on increasing the discount rate and we can see that the net present value is approaching zero and zero nearer and nearer. So now in this question, conveniently in the solution, the exact discount rate where the net present value for project A is zero is given to you. But practically in your exam, what you can do is you can consider another discount rate of 25% after 20 and 30 after 25%, right? By doing all of that, you will see that for project A, the net present value is nearing to zero, somewhere near to 25%, and the net present value of project B is becoming zero at 25.8%. Now of course you can just if you were doing this in your exam, so you might have one value here and another value here, so you can just extrapolate, and similar to the one that I have shown you, you can find the equation to find the X value or the exact IRR value, or you can do trial and error method by taking different discount rates between 20 and say 25, and then you can find the exact discount rate where your net present value is becoming zero. So use the similar concept that we have done for the previous exercise to find the exact IRR. And once you find the exact IRR, you can compare the internal rate of return between these two projects. So for project A, your IRR is 24.3. And for project B, your IRR is 25.8. So which one is a better project? Project A with 24.3 IRR or project B with 25.8 IRR? So which one is a better investment option? Could you please show the process of building IRR chart? Okay, hang on. So what you can do is, let me just click on here. So for the first one, you can just select the discounted cash flow. So I think it's not very organized here, but to build this, so you just have your internal rate of return. So yeah, so different discount rates. So over here, this shouldn't be IRR, so this should be actually discount rates. So you have your discount rates and you have your net present value. So what you're going to do is just select both of this, and then you can go to insert, and then okay, let me select it one more time. So you have your discount rates, you have your net present values, and then this as well. Let us just try to go to insert. Why are there three lines coming up? Okay, so never mind. I don't know why this plot is coming up. Yeah, it should be this. So you have your net present value versus your discount rates for your project A and for project B. Of course, it is written series 1, series 2, and series 3, but just try to rename it with project A and project B, net present value for project A and project B. So you just select this and you can get the line over here. So, and if you want to put equations to this, let me try and do it here. So you can right click, I think it was add thread line, yes, and then try to fit. So your polynomial is the best fit, as you can see, and you can put the order after 3, and you can solve it by using a simple calculator and just go to display equation on chart. And if you do this, then you can see that you got the equation. Let me try and expand this. Then you can see that for project B, you got the equation, and of course you can increase the size of this. Sorry, let me try and increase the size. So sorry about this. How do I suck at Excel? Sorry. Yeah, so if you see here, then you can see that y should be equal to 0, which is a net present value. And by doing this, if you don't know the exact IRR, so you can put the values in this equation. So your y should be equal to 0, and then you can find the value of x by using this. Or you can also use Victor's way of just trial and error between those two discount rates where your net present value is going from positive to negative. Okay. Hey, lot of notification on the chat. Okay. Y-axis and x-axis is different though. Should x-axis, sorry, what? Hang on. Let me read. Okay, Emiliano, y-axis and x-axis is different though. Should x-axis always be y-axis? You can use either way, but one of the axes should be net present value and the other should be discounted cash flow. Oh, sorry, the other should be discount rates. What the recommended interval between discount rates? Because there we can see that the IRR is 4 and 5 and it should be 20 and 23. Oh, did I select something wrong? Okay, let me try and see this. Oh yeah, I think okay, let me try and do it again. You guys can also try it out in your Excel. Did I select something wrong? Yes, I did select something wrong. So let me try and do this again. So we select the internal rate of return and we select the net present value. Okay, let us first try to just put this to. I'm not sure what's wrong with this. Okay, something's going on with my Excel. Let me try and do, okay, let me try and do this one, okay? So we have our, say, discount rates over here. We have our net present values over here. Insert destination reference is not valid. Can you guys do this? If you just select this tool and just go to insert and then it should be recommended charts. Okay, sorry, over here. And then you can get something like this. So this is your net present value versus IRR. So let me try and do it one more time for this. So if I select all of this, insert, why is it coming like this? This is the IRR. Net present value. Oh, yes. So what you have to do is, sorry, I'm not sure. I'll try to find this, but I'm not sure why I'm not able to plot this in the X and Y axis. Do you think that I should change the orientation of these numbers? Can anyone help me out on this?
I think you can
So
if,
like put this
if,
in the
if
x-axis, this in the y. Is there any way of changing that?
yeah, I think you can just click on them and drag them, not on the pivots, but on the lines.
Mm-hmm. Drag them to where? Over here?
No, like on the blue square, the shaded area in blue. If you go
Mm-hmm.
up, and then
Over
to
here.
the right a little bit, yeah, that one. If you
Mm-hmm.
click on the line, on the blue line on the right, but yeah, you can drag those ones. No, but you
I'm
have to
not
be
sure.
correct on the line.
Okay, if you guys can try and solve this, please do it yourself. I'm really bad at Excel. But what you do is just this should be in the x-axis and this should be in the y-axis. Okay? So try to do it yourself. Try to figure out before I come to the next workshop and I'll show it to you guys. I'm really sorry about this because we don't have a lot of time left. Okay, anything in the chat section? Whoa, a lot. After the formula for NPV and rate, how to calculate the equate IRR. Yes, just put the equation, find the equation and put the value of y as 0 and you can find the value of x. Okay. So yeah, a couple of things that we need to sort out in our next workshop. So I'll definitely try and figure this out and I'll show it to you later. Okay. I'm not sure why this is not working in mine. All right, let's get back to our workshop. Where was I? Okay. All right, so almost, yeah, done with the calculation. Sorry about this. As I told you, I'll figure it out in the next workshop. So couple of MCQ questions, and then we are going to look into some of the queries you guys have had in our last workshop session. So before that, let's look into the MCQ questions. Okay, so the first one is choose the correct option for the following questions. The concept of time value of money is important because it focuses on earnings through return interest of an invested amount. It recognizes that $1 received in the future has lower value than $1 received today. The concept can be applied to future cash flows to compare different income streams or all of the above. So what do you guys think is the answer? Anyone? Option number 1, 2, 3, or 4. Number 1. Okay, what about the others? Yes, number 4, right? Because all of this makes sense in terms of the concept of time value of money. So the first one says that it focuses on earnings through interest, through return interest of an invested amount. So this is how, this is the reason why we invest in banks, right? So if we invest something today, then we are going to get some returns, and this also, with passing time, and this also depends on the concept of time value of money. And second one is it recognizes that $1 received in the future has lower value than $1 received today. And this is also true, right? So you would rather want to get that $1 today, invested in the bank, and make some money with time rather than receive that $1 in the future. And third is the concept can be applied to future cash flows to compare different income streams. And that is what we did in today's exercise. Um, we apply the concept of time value of money to compare different investment options by looking at the future cash flows. So the answer is all of the above. All right, second is if the discount rate reduces, the present value of a future amount also decreases, increases, remains same, depend on stock market. So what is the answer to that? So just go back to the formula of discounted cash flow. So is the rate in the numerator or the denominator? So how is this R value going to influence? Number two, yes, increases, right? So if you look at the discounted cash flow formula, then we know that the present value is the cash flow divided by 1 plus R. So this R is in the denominator. So if the value of R reduces, the present value increases. All right, next is the future or present value of an amount depends upon what? The interest rate, number of periods, number of times per year compounding occurs, all of the above. So again, look at the formula. So what are there in that formula? Yes, number four. So all of this, right? So the interest rates are, we need R to find the present or future value. We need N, which is the period, and also how many times are we getting this interest rate every year. So how many times are we discounting it every year? In all of these questions that we have solved in today's exercise, we were considering this discount to be applied once every year, but there can be more than one times in every year. So all of the above. Okay, so this one again, you will have to do a, oh sorry, number D. The net present value of a cumulative positive discounted cash flow can become negative as discount rates become higher and higher. Okay, so what is it is saying is, let me show you this equation. Okay, so imagine that all these cash flows that you have are positive. So if all of these are constant, and we know that R is inversely proportional to, wait, hold on, Jen. R is inversely proportional to the discounted cash flow. So when R reduces, discounted cash flow increases, or when R increases, then this reduces. So the question says that if all of this are positive, the cash flows are positive, and if we keep on increasing this R value, then do you think that we can get a negative discounted cash flow? So do you think that just reducing R value will give us, just increasing R value will give you discounted cash flow, or you will have to have a negative cash flow here? So what is the answer? No, right? So the answer is yes. So the answer is no matter how much you reduce your R value, until and unless we have a negative cash flow, your discounted cash flow won't be negative. Okay, in order to have a negative discounted cash flow, you have to have some negative cash flow in the future. So no matter how much you increase this R value, DFC will never be negative until and unless we have some negatives here. Okay, that was number D. So only cash flow is negative, then yes. So only if we have some negative cash flow, which is very with a very high value, then only your DFC can be negative. So no matter how much you reduce your R, if all the cash flows are positive, your discounted cash flow won't be negative. Okay. All right, so the next question is, you would rather have $10,000 pay out today, considering you will not invest it, than all these four options. So what you have is you have your present value. This is option one, where you have a present value of $10,000. So would you rather have this value today or any of this in the future? So again, what you have to do is, this is your initial investment. Oh, sorry, this is what you're receiving after 5 years with 6% discount rate. So you have to discount this to the present value by cash flow, which is 15,000 divided by 1 plus R, which is 6% to the power n, which is 5. So do this for all the three options. Maybe you can quickly try and do this and try to find out what is the present value for all these three options, and then compare it with this. So if any of this is giving us a value which is higher than this, then you would rather take this than go for this option, right? So can you tell me what is the present value for the first option? 15,000 divided by 1 plus R to the power 5. Okay, 11209, which is higher than what we have in scenario 1. So this definitely is a good option. But before jumping on to this, let's look at the other two options. What about this option? Second one, 14,000. Okay, 11506. Victor, is this for the second option? Okay, so again, this is a bit higher than. Okay, Jin, you need to catch up. So, cash flow divided by 1 plus R, which is 6% to the power n, which is 5. So, just the discounted cash flow formula, right? So, we want to compare this in present value. So, what about the third option? I'm just blindly, trusting the numbers that you guys are giving, okay? So, what about the last option? 10578. Okay, so which option is the best option? Which one, by investing in or by going for which option? Yes, so number two. So number two is giving us the highest return. So rather than taking this $10,000 today, you would rather go for $14,000 after 5 years if the inflation rate is 4%, right? So this option is the best option. Okay, so what if all these inflation rates were same? So what if this was 6%, this 6 and this 6, and you have varying numbers here? Then which option would you have gone to? Even without calculation, you can say that. So would you rather go for 15,000 after 5 years with an average of 6% or 14,000? Yes, of course, right? So if all these inflation rates were same, then you would just go for this option. So more money after 5 years, right? So yeah, that okay. So sorry, we have one more. Okay. Um, Number E, or it should be F, I guess. Yeah, this was E. Anyway, so the last question. As the time period until receipt increases, the present value of an amount at a fixed interest rate decreases, remains the same, increases, not enough information to tell. So try and dissect what this question is saying. As the time period until receipt increases, the present value of an amount. So in that equation, so what we're increasing here is n is increasing, right? Time period or n is increasing. So the present value of an amount at a fixed interest rate increases, decreases. So let us look at this equation. So what is happening is cash flow is same, your R is same, so you are just increasing your n. So if n increases, then what will happen to this? It will decrease. Yes, so this is your option, right? So whenever you get questions like this, just look at the equation and try to fix all of this and look at what is the variable. So in this case, n is the variable, and the question is asking if the present value will increase or decrease. So if n decreases, which is in the denominator, then your discounted cash flow will also wait, this should increase, right? Because you are, oh sorry, you are increasing this, so this should decrease, so inversely proportional. So yeah, your present value will decrease. So any question regarding the MCQs? If not, then let me quickly go to my email to get the responses from the last workshop from Soradeep. um, Hang on, sorry, I have a lot of emails buried, just give me a second. Yes. Um, so what I'm going to do is put the first question and the response that I got from Soradeep in the chat section. All right. Whew, quite a long description from my side. So what is there in this first question that I asked to Ali and Soradeep was, if you remember in our last workshop, we did came up with a query in finding the EAC. So when we want to find EAC, first we have to find the CPI cost performance index, right? And while we were finding CPI, some of us took the exact value, which is 0.866666, and in the solution it was rounded up to 0.87. And depending on which CPI value, whether we are rounding up to 2 decimal points or not, we could see that the EAC, we are getting different EAC values, which was, I think, with a difference of $40. So I asked to Sauradeep and Ali that this might be confusing to the students, especially in the MCQs. So I think we can give them some instruction to round it up to 2 decimal points or not. So his response, the Sauradip's response is in the bottom. So he wrote that, sure, in case of MCQs, the choices would be more distinct to an extent that such approximations won't lead to a wrong selection of options. We can put an instruction about rounding up. So he told that either you guys will be given an instruction to round it up to 2 decimal points, or if there are no instruction, then the CPI value won't be, you won't be getting this kind of CPI values. So the option will be pretty clear to you guys. Okay, so this is the first question. All right, so regarding the next question that you guys had, so this is just a combination of all the questions that I got from all the 3 workshop sessions carried out last week. Okay, second question is 5B. If you remember, then there were some situations and we had to decide whether to consider the situation as a top priority or a low priority situation. So this is my question to him. So the scenario is the client has requested some changes in the designs after initial approval, which would be delayed by the authority submission date by 2 weeks. And some of you argued that 2 weeks is not a big delay, so we shouldn't consider this as a top priority situation. But in the solution, it was given that since this change for the designs, the submission of with the change for design, it will be made in the month of December, January, which falls in the day season. So this will considered as a top priority situation. So I asked Sauradeep that this is considered as a top priority issue, especially considering the holiday period. The students were wondering if this would still be considered as a top priority situation if it did not fall in the holiday seasons, given that it will cause a delay of only 2 weeks. So that was my question. And his response is that in this particular context, this becomes a top priority due to the holiday period. So yeah, keeping that in mind, this has been considered as a top priority situation. Else, there is sufficient time to address the change and submit. So if you remember, there was a gap of 1 month from submitting the design to starting the construction. So if this was not sorry, Jen, I'll get back to you. So if this was not in the if this was not in the holiday period, then this would have been considered. This would not have been considered as a top priority. So this example, further he writes, this example drives home the idea that project management also need to consider the situation context beside the number of days and cost. So yeah, so this is what exactly he was trying to convey from this question, that if this would have fallen in any other time of the year, then 2 weeks delay would not have been a top priority situation. But since this is falling within the holiday season, so this will be considered as a top priority. So if you get questions like this in your final exam, then I'm 100% sure that you will be given a chance to explain your answer, which I'll get back to you in one of the other replies he has written. Okay, so this is quite a long one as well. So, okay, sorry. Um, all right, so, okay, Jen, I'll get back to your question. Okay, let me quickly finish all the queries. So again, there was another case in question number 5D. And if you guys want to get back to, have a look at his replies later on, just copy all of this text, and maybe I should put, like, can I edit it? Oh, unfortunately, I can't. But I guess you can. The last paragraph is Sauradip's reply, and the uh, starting paragraph is my question to him. So, okay, so let's have a look at the last query that we had from last workshop. So, question number 5D. What was the question? All right, sorry. Um, Okay, so I just put the reply from Soradeep. Um, this is the question. Sorry, I messed it up. So this is the question. I'll put the reply again. So the question is, around November 2023, the client informed you that few of the facility management staffs would not be available for training until 28 Feb 2024. So this was our question, right? And then this was not considered as a top priority situation. This was considered as a low priority situation. And I believe, Emiliano, you had this question that this definitely is going to push back the project submission date. So why isn't this considered as a top priority? So this is my question. So this is considered as a low priority issue in the solution. Some students did not quite agree with this consideration. They argued that this situation will push back the project submission date and hence should be considered as a top priority. Could you please provide your thoughts on this? And his solution, oh sorry, his reply is this. Okay, so he says that in this case, the delay does not severely impact the company and thus it can be amicably addressed as rescheduling the training. So this was my comment. Okay, I asked Soradeep. I was wondering if there is a scope of disagreement regarding what should be considered as a top or low priority issue. Is it subjective or hardline? As many of you will agree that some of this can be a bit subjective. So this is what I asked, and he replied that yes, there are scopes of disagreement with justification. Such questions won't appear in MCQs. Rather, the students will have the chance to pitch their reasonings for their selection. So this is what I was saying. So whatever reply, whatever answer that you write for those questions like this, try to give a strong justification of why you're considering that as a top or low priority situation. Well, that was not the case in yesterday's quiz. Oh, were there conflicting questions like this as well in yesterday's quiz? Some subjective kind of questions? Oh, I'm sorry to hear that. Unfortunately, I have no idea, about the quiz questions. All I can do is just, convey the issues, as you can see from my email, that I was trying hard to convey the message, to them that some of these questions are subjective and the students should be given a little bit of slack to, or a freedom to reply. But anyways, so what he told that in this particular case, question number 5D, since the delay is from the client side, right? Where is this? Um, where was the question? Yes, decline. So if you see question number 5D, the last paragraph on the chat, so here you can see that the client informed you that the facility manager staff would not be available. So this delay is from the client's side. So as a project manager representing a contractor's side, so there is no fault from our side. So this delay is due to a decline from the client's side. So even if the project submission is pushed back due to this, you won't have to pay any liabilities, so this won't be considered as a top priority issue. Okay, and coming back to Jin's question, where was it? So in question number 1, both of them are true. So Jin, in question number 1, what Soradeep is trying to say is you will be given such questions in your exam where already the CPI value will be within 2 decimal points, or if you have a bigger number with a lot of numbers after the decimal points, then you will be instructed to round it up to 2 decimal point values. Okay, so you won't have this kind of situation arising in your exam. That is what he replied. Or the options that will be given to you won't fall in this range. So it will be very clear to you if you use, it will be, or all in all, it will be instructed to you whether you have to round it up to 2 decimal points or not. Okay. So any other questions from last week's workshop, since this is also a consultation session? So if you have any other questions, and there were a couple of issues I acknowledged in today's workshop. So regarding plotting the graph, regarding net savings, and regarding savings to investment ratio, I'll definitely talk to Ali and Soradev again, like I did last week, and I will sort it out or clear it out in our next workshop. Okay. Can you give your email address? Okay. Uh, but I would suggest it's better. Wait, 517675. If you put your queries on Moodle, because that way, Ali and Sauradip can directly address to it, and whatever queries you have in your class, anyways, I'm going to address it in our next workshop. So yeah, but if you still have something, that's my email ID. All right, so do you guys have any other questions apart from this? Could we have the Excel for this workshop? Yes, Han. So the Excel will be uploaded on Moodle very soon. So we have another workshop session at 3. So once we are done with that, and also there were some minor corrections needed. Sorry, let me stop the recording before that.